Welcome back to Your Average Investor. Today we're going to talk about risk management in day trading and swing trading. Now, if those of you who are just tuning in are new to the channel, please subscribe. It means a lot to support us. And as always, this is just financial education, not specific advice for you or anyone in particular. That being said, a lot of people get into day trading or swing trading because they want to find a way to earn some extra money, and maybe they're not of the opinion that the market is perfectly efficient, and they want to take advantage of things like this, right? Palantir, after hours today, dipped all the way down to $22.50 per share. Now it's sitting at almost $24.50 per share. If you would have bought this dip and just held for about 30 minutes, you could have made about an 8-9% gain. Dang, that sounds pretty good. Why don't I do that? Well, the reason a lot of people don't, or maybe they start and have stopped, is because they don't understand how to trade profitably, and they think that it's some secret sauce about one of these millions of indicators that if I just add this indicator, then it's going to help me win. The truth is, it's all about risk management. So that's what we're going to talk about today, and I'm going to completely demystify it and make it incredibly simple. Now, there's two types of risk management, and you can use either or both. It really doesn't matter as long as you're holding to your strategy. One is a risk management by position size. The other is by support zone. Now, both of these do the same thing. It just changes how you calculate where your stop loss is going to be. And I'm going to use a couple of different examples for this. So let's just say that I wanted to buy the S&P 500. I wanted to buy SPY because I'm like, you know what? We're on a nice bull run after a dip. I think it's going to keep going up. And so I'm just going to go all in on SPY and see what happens for a quick trade, a quick week-long trade, maybe a couple week-long trade, see what goes down. Well, in this case, let's just pretend I've got an account size of $10,000. The first thing you need to do is establish your max risk. Now, standard advice is your max risk, this means the maximum amount that you'll lose on a single trade is between 1 and 3%. I've set it at 2% here just to make it right in the middle, but 1 and 3% is standard wisdom of if you do too little, if you're doing like 1/4%, then you're probably not making enough money to make it worth it, and it'd be better just to throw it into an index fund and let it grow naturally, not have to do the stress of trading. If you do more than 3%, then you run the risk of blowing up your entire account too quickly by hitting a bad streak of trades. So 2%, that means my total loss can be $200, right? If I've got $10,000, 2% of that's $200, meaning if on my trade I lose $200, I need to exit the trade and find a new trade. In this case, I'm going to be trading SPY. The current price of SPY, as it was last pulled by Google Finance, was $516.57. What this means is with a $10,000 account, I can purchase a total of 19 shares of SPY. That brings me just under $10,000. And if I were to buy 20, it would bump me over. So 19 shares of SPY. Now, if I'm going all in on this, that sounds counterintuitive. It's like, wait a sec, you said you shouldn't be doing that because you've got to play the max risk at 2%. And if you're putting in $9,800, that's way more than 2%. What if, well, SPY's not going to go to zero. But what if it goes to zero? Well, that's why you set a stop loss. You don't have to manually set a stop loss. It could be a stop loss in your mind that you just know, hey, if this stop loss gets hit, then I'm going to exit the position. And the way to calculate that is to say, okay, I'm buying this many shares, and this is my total loss. So if I take my total loss and I divide it by the number of shares that I'm purchasing, that gives me a loss of $10.53 per share. In other words, if the S&P 500 drops below $506.04, I need to exit the position and wait for a new trade. And if I do so, even though I've leveraged nearly my entire portfolio, I've only lost 2% on that trade. So that's how you leverage by position sizes. You just say, you know what? I'm going to position my entire account. You don't have to do your entire account, right? I could say I'm just going to buy 10 shares and I'm only going to put half of my account into this. I'm only going to buy $5,000 worth of SPY. Notice what happens. Now my stop loss per share goes up to $20 per share because, again, my total loss, my risk is still the same, 2%, $200. So now I can have a little more wiggle room there, right? If SPY dips down to 496.58, I'm still okay. I still haven't hit my stop loss, and then it can move back up and maybe turn into a winning trade for me. And again, if I cut that in half again, and say I'm only going to buy 5 shares, well, now I've got a lot of wiggle room here. SPY can move down about 8%, 7%, and I still don't have to sell because I haven't hit my total loss on the position. Now, there's another way to think of this too, and it's by support zones or breakout zones, whatever you want to call them. I'm going to show you Palantir for this one. Let me first just jump over to Palantir here. So let's say that I saw this price action happening on Palantir, and I wanted to do a quick analysis on support and resistances. And so I pulled up this chart and I said, okay, well, it looks like there's some pretty big resistance going back multiple years at around 27.5. There was some support way back here around $20 per share that turned into resistance up here more recently, but then it broke through this last earnings, and then that most recently acted as support at around $20 per share. Like, okay, if the $20 per share is support and it's currently trading at 22, we'll say I was looking at it at $23 a share, right? So let's pretend that I wanted to get it at $23 per share. So I'm going to update that manually right now. And the support zone is $20 per share. So here's how this works, right? I've got a $10,000 account size. Same thing, max risk is 2%, total loss is $200. And I'm going to be looking at Palantir, and the current price, just pretend, is $23. That's when I was looking at this. And I know the support zone is $20, which means if support breaks, I'm out, right? If it goes to 19.99, I'm out because the support's broke and I've got to move on. Well, in that case, this is going to tell me the maximum number of shares that I should purchase if I want to respect this $200 total loss, 2% loss of my $10,000, right? So if I say, okay, what's the difference between 23 and 20? That's $3. And what's 200 divided by $3? Rounded down, it's 66 shares. If I take 66 and I multiply that by 3, I get 198, right? So that's my stop loss right now. Okay, so I've got 66 shares. That means this trade is going to cost me $1,500. I can spend $1,500 in this trade. I can buy 66 shares. And now let's say I did enter this trade, right? And I'm like, oh, this is perfect. I'm back up at 24, I don't know, 80, maybe 25 is when I'm going to decide to exit. Maybe I think 25 is the resistance right now. So I'll exit when it gets to 25. Well, what's beautiful about that, I entered at 23. I'm going to exit at 25 for a nice profit. So 66 times 2, right? If it goes from 23 to 25, that is my profit. So times 2, I've got a profit of $132 here. Now, that's how you manage the risk on this trade. The other thing to consider with this that we're not going to go in on today's video, but we'll have more videos on this later, is your win-loss ratio, right? If you're winning, say, 20% of the time and losing 80% of the time, even if you're managing risk appropriately, that's not going to be a great win-loss ratio unless your average win is making you like a 500% profit or a 1,000% profit, right? So that's the other part of risk management, is knowing what's my win-loss ratio and what's my average win percent. Because you already know your average loss percent is going to be 2% of your account size. Well, if I know my win-loss ratio is, let's call this 50%, so let's say if my win-loss is 50%, then I need to be making at least 2% or $200 on my wins in order just to break even, right? And ideally I should be making $250 or $300 on my wins so that my wins over time outpace my losses. We'll get into that in another video. Hope you enjoyed this. Again, if you haven't already, please subscribe for more videos like this. Let us know in the comments if you have any question. Good luck investing. We'll catch you next time.